Welcome back everyone, and in this video, we're going to take a look at two dividend companies who have been growing their annual payment to their shareholders by a massive amount each and every year. These are two of the top dividend growth companies on the market, and they offer investors a very nice starting yield, and that compounding growth is absolutely incredible over the long term. And for each of these two companies, we're going to take a look at their current financial position, the company's financials, and of course, their dividend growth and the company's dividend safety. And right now, if you're looking for some income in a very volatile market, these may be two companies to offer both dividend growth and a lot of share price appreciation over the next few years. And before we take a look at stock number one, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos. And the first dividend growth company that we're going to take a look at today is ticker HD, and that is the Home Depot. They currently trade for $303 per share, and from the March lows, the company has grown by over 63%, and they have a current market cap at $315 billion and a current dividend yield at 2.2%. And right now, Home Depot is one of the largest retailers within North America, and the company actually got an incredible boost because of the 2020 pandemic. And with consumers being forced to stay indoors, a lot of them spent more money improving their homes and doing all the projects that they have been putting off. And Home Depot, the number one home improvement warehouse, saw incredible growth in their sales in the fiscal 2020 year. And going forward, these home improvement projects are only expected to continue because consumers are still going to be spending more time at home than ever before, even as the vaccine gets distributed, and hopefully we can go back to normal. And even if the pandemic comes to an end in 2021, there is one major shift in consumer spending that I believe will be permanent over the long term, and that is the focus on digital sales and e-commerce. I think throughout this pandemic, more individuals than ever have started using e-commerce to make their purchases, and I think that trend will continue over the long term, and I believe Home Depot is well equipped to capitalize on the growth of the e-commerce sector over the next few years. And the company has spent over $11 billion for a full digital transformation of their website, of their app, and all of their social media channels, which has led to 238% growth in consumer engagement. And recently, Home Depot just got some great news and another boost thanks to the government and the next round of stimulus hitting consumers' bank accounts. And analysts are projecting that with the stimulus money combined with tax refunds and much of the country not fully open for business, that individuals and consumers are going to continue with the remodeling boom, and Home Depot's going to get a great benefit now that tens of millions or even hundreds of millions of people now have some extra discretionary income. And over 2020, because of the pandemic, Home Depot sales absolutely exploded and grew 20% year over year to $132 billion. And their earnings for the fiscal year of 2020 also grew 16.5%, which is absolutely amazing. And Home Depot is one of the top dividend growth stocks on the market right now. They have a current dividend yield at 2.2%, and they only pay out 52% of their net income in the form of that dividend. And over the past 5 years, their average annual dividend growth rate is at 20%. So every single year, your starting yield and your annual payment is compounding and growing at over 20%, which is absolutely incredible. And this is one of the highest rates on the market right now. And even with this incredible dividend growth, the company maintains a very safe payment coming in with an 87, which means we're not expecting a dividend cut to come from Home Depot anytime soon. And if we take a quick look at their financials, we can see that total revenue continues to grow year over year with that massive spike in 2020 to over $132 billion. And going forward for the next 5 years in the future, analysts are projecting from where they are right now that their total revenue and net income continues to consistently grow year over year until 2026. And at this current level, the company is considered a buy with 9 strong buys, 18 buys, 9 holds, and only 1 single sell. And for the next 5 years in the future, Wall Street analysts are projecting between 8 and 9% annual share price growth, plus their 2+% dividend. You're looking at an expected 10+ annual return coming from Home Depot for the next 5 years in the future. And if you want exposure to the retail space, but also a company that I believe will continue to dominate in-person shopping over the long term, then Home Depot may be a great player. With many small businesses still being shut down all across the country and extra money hitting consumers' bank accounts, Home Depot may be a place they're going to spend it, and that could lead to a great quarter in the next year for the company's total revenue. So that was the first dividend growth company that we're going to go over in this video. And now if we move in to stock number 2, we have ticker AVGO, and that is Broadcom. They trade for $480 per share. And over the last 12 months, from the March lows back in 2020, the company has grown by 112%. They have a current market cap at $186 billion and are currently trading with a forward PE of only 17.2 and a nice dividend yield at 3.12%. And Broadcom is the top player in the semiconductor industry, which is projected to see a ton of growth over the next few years. And even after the massive run-up in share price, the company is still considered to be close to 20% undervalued at this current level according to their future cash flows. And right now, the current share price of $482 is well below the Simply Wall Street estimated fair value of $602 per share. So definitely some upside to achieve their true fair value over the shorter term. And in 2020, Broadcom generated $23.9 billion of total revenue and also invested over $5 billion in their research and development. And right now, they have one of the broadest intellectual property portfolios with over 20,000 patents. And for this year, we're expecting some great results because of the chip shortages, which has sent a surge in demand. And the Broadcom CEO says sales numbers are real and the chip orders are flooding in. And he's projecting over 17% growth in chip sales over this next fiscal year. And something to note is that Broadcom customers cannot cancel their orders. So this is a great sign for the company, and right now, he believes that 90% of Broadcom's total supply has already been ordered by its customers. So that's amazing. To already know this early on in the year, your entire supply throughout 2021, and the fact that their customers cannot cancel their orders, I believe this year is going to be another phenomenal result coming from Broadcom, and the share price may continue to surge well above where it is right now. And we can see that over the longer term, total revenue has continued to expand at a massive rate. And from back in 2009, where they only generated $1.5 billion of total revenue, they have more than 16x that number to close to $24 billion in 2020. And we can see over the past few years, that number has been accelerating. And in research and development, which is how these companies continue to grow, they have to stay innovative and they have to continue to come out with new and improved products. Every single year, they've actually grown their research and development spending from around $0.2 billion back in 2009 to $5 billion in 2020, which is a fantastic sign. And we can see all of their financial metrics have been improving year over year. Net revenue, like we talked about, has hit $24 billion. Their gross margin has improved all the way up to 73.5%, which is absolutely insane. They have adjusted EBITDA at over $13.6 billion in 2020, and one of my favorite metrics is their growth in their free cash flow, which has absolutely exploded over the past few years, and in the trailing 12 months, they generated $11.6 billion of total free cash flow, which is absolutely incredible. And as a dividend investor, I love to own the companies that can generate more and more cash every single year, because that's how dividends are paid, in the form of a cash payment to their shareholders. So if a company continues to generate more cash every single year, that leaves more room to continue to grow that payment and return that capital back to me in the form of my quarterly dividend. And we can see Broadcom has been one of the top dividend growth companies over the past 5 years, and that annual payment has been growing at close to 50% per year, which is absolutely insane to even say. Right now, the company's annual CAGR is at 49%, and they've grown their payment from back in 2016 from $1.94 per year to all the way up to $14.40, which is absolutely insane. A 50% CAGR from a company worth $186 billion is incredible to even say the least, and I love owning this company in my personal portfolio. And to get this massive CAGR, their starting yield is on the high side as well, coming in at over 3%. So usually when companies are growing their dividend at such a fast rate, you're getting a starting yield at 0.5%, maybe 1% the most. But Broadcom is very unique. Their current share price offers a 3% dividend yield. Their payout ratio is very sustainable, only coming out of 54% of their net income, and they've been growing it at an incredible rate year over year. And we can see that at this current level, they're forecasting to grow earnings by 25% per year, and from where they are right now, we're expecting the total revenue and earnings to grow each and every year all the way past 2023, and the company is currently considered a buy with 7 strong buys, 19 buys, and 5 holds, and no one is selling out of Broadcom. And for the next 5 years in the future, Wall Street is projecting around 8 to 9% annual share price growth coming from Broadcom. Tie in that 3+% dividend, they're forecasting around 12% annual growth. And remember, that dividend is compounding at a very fast rate. And right now, Yahoo Finance has them as a slight strong buy, coming in at a 1.9, and the current share price of $482 is well below the 12-month price target of $511 per share. So if you're looking for a company in the semiconductor industry, which is pretty much filled with all growth stocks, but you want a dividend, take a look at Broadcom. They have performed extremely well over the past 5 years, and I don't believe their growth will slow down anytime soon. So now we're going to wrap up the video. Thank you for watching to the end. In this episode, we took a look at Broadcom and Home Depot, two of the best dividend growth companies on the market, offering their investors annual dividend growth of 20% and close to 50% every single year. And these are two companies I own both in my dividend growth portfolio that now has a value just shy of $91,000. And if you want to follow along with my personal investing journey and watch this portfolio continue to grow every single month, then please hit that like button, subscribe for the daily videos, and I will see you in tomorrow's episode.